Hello, Michael Hopkins at Seeking Alpha again with Jennifer Warren at Concept Elemental. How's it going?
Good. Good to see you, Michael. It's
Good to
been
see
a,
you again.
a
Yeah.
month, a month since our last one, I think. So
And you know what? A lot has happened since then, and we're going to talk about that. But I think the bigger thing, if we want to just jump into it very briefly, um, I mean, there's a big macro picture I think we're going to want to talk about. But right now, what are you looking at in general? What are the things that you're seeing?
so what we're going to talk about is first of all, February 3rd, there was an event by the Dallas Fed, and they gave their Texas economic outlook for 2023. And of course, as we know, with the Fed, it's all about where interest rates going to end, and inflation and how's that trickling into the economy. So I have a little color about Texas. And then, which is interesting because Texas is kind of a little bit of a unique situation relative to the rest of the US districts, Fed districts and states. And then we'll talk about some oil and gas. We'll pivot into that and then have a little stop and then talk about infrastructure as an alternative way to sort of play the energy transition, which also syncs up with an inflationary interest rate sensitive environment and also just some macro themes to do with infrastructure and the energy transition. So I will just start screen sharing and we'll look at some of my slides and then we'll stop after the oil and gas slides. Okay, here we are. So you got it, all right?
Yep, I can
Okay,
see it.
so just to jump in, so this is an interesting slide from the Dallas Fed event again on Texas economic outlook. And as you can see here, this is job growth in Texas and then compared to the US. And here on the far right, you've got the oil and gas sector. It's almost 13% job growth in 2022 in Texas, 13% in the rest of the country, which is kind of interesting. You'd think it'd be more in Texas, but it is what it is. But basically what it's showing you is it's where a lot of the action was last year in terms of job growth. Oops. Hang on, my thing is not responding. Hang on. There we are. I don't know why that was happening. Okay, so next slide is just about, because there's been a lot of focus in the markets about, when the payroll comes out and how are the jobs doing? I mean, are we adding jobs? And then how's that going to translate into the Fed wanting to raise interest rates? If it's a hot job market, you feel like the Fed is going to keep raising. So basically what this is showing is this is a benchmark situation. And basically the Dallas Fed did this. And so Texas, the gray is the unbenchmarked job growth for last year. And as you can see here in June, unbenchmarked Texas job growth was like, roughly 5%. But then what happened was, which is interesting, is once they benchmarked to actual data, in fact, the revision was markedly lower. So you went from like nearly 6% of job growth down to, nearly 4% decline. That's a big difference. So if the market is reacting over here to all this job growth, but then, a year later, 6 months later, there's a, big revision. Oh, that wasn't right. It just means you're getting it wrong, right? And then you have to readjust your investment strategy. So the market reacts to this news, but then, it gets revised and it's changed what the real picture is. But anyway, I just thought that was interesting. And then this is a little bit about just drilling in Texas, the rig count. As you can see here, in 2022, it's just kind of hovered, it's been kind of flattish. And even in spite of WTI going up, the rig count has stayed steady. Again, speaking to that restrained growth that the oil and gas industry is adhering to, and that is because of investors, and that is because of, somewhat to do with the energy transition, and also now somewhat to do with, demand. And then next here, you'll just see that, so the DUC counts, the drilled but uncompleted wells, it's the red line here, and, very high amount that were drilled during the pandemic. Now, those are being completed, rig count holding steady. So basically they're going through that inventory, which means at some point, there will be more drilling happening. And then this is just kind of interesting. This is also from the Fed. And it's just showing loan volumes declining in real estate. And here with the red is the commercial real estate. The blue is residential. The green is commercial and industrial. So as they expected, with interest rates rising, those sectors that are most sensitive to interest rates, are reacting. So that is happening. So kind of, I'm saying real estate loans speak, they're kind of telling us, the reaction. And then of course that trickles through the rest of the economy, all that. So the sort of high level notes is that there are signs of slowing, which are spreading, that the benchmarking, tells a bit of a different story on the labor market. Energy market's robust in Texas, and that Texas is in fact poised for a soft landing, a bit better than the rest of the nation. And partly that's because of energy, but that's not the whole story. There's also a lot of in-migration in Texas, and that is both from, people coming from California, New York, firms setting up shop here, their employees moving here. There's also been a lot of international in-migration into Texas. So we've had this influx of businesses and labor that have kept our economy, at a higher growth rate relative to the rest of the country. But we're forecast to grow more slowly. And those trends I just said with the in-migration, we're not going to be able to count on that forever. And we're also seeing signs of, when you have too much growth, the cracks start showing. And I wrote this story called Texas $1 Million Miles, and it's about the grid, and it's about how growth, when there's go growth, you start seeing different resistance to that growth, just because you can only grow so much and there's only so many resources, and there comes a time when it starts abating. I don't know when that point is, but some of the cracks are showing, like I've said. So there are risks to the downside, they were saying in general. But if hypothetically we had a really terrible recession, Texas would go down, but not as much, but I think they were estimating just under 2% growth in Texas. So now, so basically, they're saying, they expect a soft landing in Texas. And, from an investor, you just want to stick the landing, right? You're trying to figure out, where to stick the landing. So, so we'll talk about that a little bit next. But yeah, interest rates, sensitive sectors are buckling a bit, under the weight of interest rates. And then, so just some quick fundamentals, 100 million barrels a day, that's just kind of, what it's looking like for a while, barring black swans and other factors. If there is really a push, with decarbonization, you could see that declining some. We're not right there to make that call. Natural gas supply, grows modestly. And this is Exxon's outlook, by the way. And then with really decarbonization, there's a lot of reduction. Not going to happen. Net zero is not happening. And this 2%, that was one of the goals. Hard to say if we're going to go there. We could. It's conceivable, but still, there's going to be a lot more natural gas used in the future. And this is also Exxon, and this is the global gas trade. And basically, the punchline of this is, North America here. So these bars, the far right is 2000. Then we got 2021, the second bar, 2030, the third bar, 2050. So basically, unconventional gas production grows in the United States. And then we start exporting more, as you can see with these little black diamonds. And then, who's sopping up a lot of the LNG trade? Asia. This orange is LNG imports, and that grows. And interesting to look at Europe here. We see their pipeline imports reducing and their LNG increasing. This is not a lot of growth, and in fact, they're looking at a reduction over time of gas usage, and maybe that's just because they sense that there's going to be more green policy in Europe. They're looking at this from today. So these forecasts and outlooks change, and here's someone who changed their forecast and outlook, and that is British Petroleum, BP, and we talked about that back in December, when I was saying, that they were kind of realizing, these gas assets are pretty good. And gee, maybe we need to shift our focus a little, which they have. And February 7th, they announced all that. But this is the revised outlook. And this is interesting because it's the first time I've really seen a firm really try to quantify the effect of the Russia-Ukraine war. And, of course, we know it's a bad effect, right? And I've wondered, how's this going to play out? This is not a pretty sight. And so what they did, this is the impact of GDP on the globe because of the war. And so here we are at 2025, and a reduction of under 3% GDP for the world. Developed world here, 2035, 2050, doesn't get hit as hard as the emerging market world. Now, that is really shameful, So basically what it's saying is this war is sucking some of the oxygen out of the global economy over time. So there it is. And then over on this side here is, this is in comparison to their last year's energy outlook. So they're saying, okay, final consumption in an accelerated trend. And that's really kind of an intense decarbonization pace. And so they're saying between the war and efficiency gains, with what's going on, we would see GDP reduce basically, and even reduce more in 2050, that the effect will be more pronounced just because of the knock-on effects from the war, and how things are changing. And then this is just back to the US well completions. We talked about those wells, those drilled but uncompleted wells, and then the completions. Well, here's where a lot of them are happening. The Permian, obviously, it's where a lot of action is. And then you've got, all the other basins kind of hovering in, around the 100 range, some more than others, some less, just because, in the Permian, there's just so much more action, it's just going to have an outsized effect. Actually, I kind of tallied it up. I don't have it right in front of me, but the Permian is like over 50% of the rig count or something like that. And like I said, we're like 5% of global oil supply. So we're, an important player, obviously. And this is just showing you in 3 months, even this, I looked at a year ago, there's the 1 year ago rig count change. And this is just 3 months ago. And what I've noticed is in these areas that were pretty hot, they are slowing down some as well. And that's just, a result of interest rates rising, demand being kind of at a little bit of a, okay, where are we going? And just the general restraint, that they're just not going to pump, guns a-blazing anymore, like in the past. Trying to think there was anything else. I said, this is the world according to BP. Back before I go there. So what I was going to say too is that on the oil and gas big picture, something from the Texas Fed conference was that executives are most concerned about demand, demand dropping. And then the other factor that has heightened, even in the last 6 months, is geopolitical risk and concerns. So that's kind of that. And then to BP here, like I said, there's a war effect. Emerging markets are hurt. This is the energy transition according to BP with their outlook. They believe there's going to be higher growth rates in renewables, higher nuclear, less oil and gas. So they're expecting a decline here in oil and natural gas. And then this new momentum case here, different than that accelerated case, which is closer to the 2-degree and net zero cases, a bit more guns pedal to the metal net zero. This is new momentum. This is like all the ambitions of decarbonization coupled with the events that have happened with Ukraine and the GDP hit. But basically that, here's 2030, and this is their outlook relative to their former outlook. They've reduced, how much carbon intensity is going to be reduced. They've reduced their outlook on those reductions, and, but there's still going to be, reductions to carbon intensity. It's just not as much as those other cases. This is Exxon, and this is sort of their own energy transition view. And this is what they're starting to spend on more. So biofuels, hydrogen, carbon capture. Last year, at some point, they had said they were going to spend $15 billion in these low carbon solutions. Now they've upped it to $17 billion. And I suspect, Exxon's conservative, and they're watching, and they're, sort of picking their horizon and seeing what others are doing. And so they've upped their CapEx expenditures on this, their view of the energy transition from what they do, their competencies, which we've talked about before in the other presentations, the other videos. Now, this is kind of interesting. This is, let me try to get it so it's a little, okay. This is, here we go. Okay, so these are the stocks. This is British Petroleum, CVX, and Exxon. So British Petroleum's here in this orange. Exxon, 40% increase in the last year, their stock price. CVX, 26%. Sorry, I had to cut that off. And then BP, just 10%. So this is part of why BP has changed their strategy to, drill more, basically, and also cut back a little bit on renewables, because they have stated that their renewable returns were like 6 to 8% unlevered, whereas the oil and gas assets are higher. And as I was going to show you on the next slide, this is kind of, if I can get this right here, this is what Exxon is saying about their returns on these various segments. So upstream, greater than 10% return, products greater than 30, low carbon solutions greater than 10%. So in fact, Exxon's low carbon solutions is a higher return rate than BP's wind and solar returns unlevered. Now, that kind of caught my attention, the unlevered part, because I think you see a lot of other numbers thrown around about returns to do with renewables that look higher. And so it makes me wonder, is there a lot more leverage with those? I mean, just what's the dynamic? I mean, and I know, different firms, it's different. I mean, there's utilities that are really good at it, right? I think that was the last slide. I'll stop sharing. Okay.
So I think it's interesting is that, um, especially the Dallas Fed stuff, and just on the macro stuff, and painting a slightly different picture, and that there might, and again, like you said, there might be some risk to the downside, and not a lot of growth. But I get the impression that maybe it's just going to be more slow and steady, more, I don't know, purposeful, more intentional about what they want to do here in terms of growth for these big firms.
You mean the oil and gas firms?
Yeah, yeah.
Yes, yes. No, I think that's right. I think we're in an environment where you do have to be methodical. You can have the ambitions, but with, interest rates rising still, projects having to be more disciplined about the projects you undertake, having uncertainty regarding, recession, where it's going to hit, what countries it's going to hit, how it's going to hit, a war, Russia's invasion of Ukraine, redrawing the energy map, all those changing equations, and then, you do have, whether you believe in climate change or not, you have some wacky, weather effects. We have more droughts, we have more rains coming when they didn't usually come. We have a lot more variables going on. And so you have to stay the course. You have to keep working and investing and, being productive. But you have to also know that there's a lot of, there's black swans. So you don't want to have your flank exposed, and I think we saw that. I think that's what's happening with triple Q in some respects, right? Just that we've just gotten a bunch of cold water thrown in our face, of reality, of economic reality and world reality, so.
So it is interesting that, even after energy had this strong year in 2022, that maybe they're becoming more disciplined, not only with just the business in general, but projects. And I wonder if that can transition to what we want to maybe talk about next, and that's infrastructure. Infrastructure
Sure.
as a reflection of the energy transition, and also the global macro direction.
Yeah, yeah, sure. And one thing I want to say about what you just mentioned about the discipline, I mean, the capital discipline and the drilling discipline, I think it is going to continue. That will continue through the year. And it's back to those themes I said of, efficiency, scale, and I can't even remember the third I had, but there's always three, it seems like.
Yeah.
But that's, that is definitely the mantra of the year. And oil and gas, it applies to, because it has to do with, resources that are finite, right? And then capital efficiency because of interest rates, and scale, because you have to produce these at, cost effectively, and with a lot of uncertainty. And so onto the infrastructure, let's see. So what's interesting about now, and partly why I wanted to talk about this too, is just that it's something that I've written about in the past. I've done some academic work with this finance professor, and we co-authored like 6 academic articles from 2006 to like 2012 on infrastructure and capital markets and all that. And so I've always had some portion of my own portfolio, aside from oil and gas, I have a number of infrastructure stocks and their funds. And because infrastructure, these funds, they tend to have diversification built into them. And then the other thing that's interesting, energy infrastructure is, all the rage, right? And, between renewables and LNG plants and biofuels plants and upgrading refineries and you name it, the transition, the change of long-lived assets. And also these infrastructure funds tend to be more linked with inflation, because they can, they're like toll road like attributes, bond like attributes. And so three themes that, and we're going to talk about Brookfield, because I'm not saying go buy Brookfield stock, but what I'm saying is, as an example of what I'm talking about, and then go do your due diligence on this. But it's kind of a way to play the energy transition differently, not being straight up in oil and gas stocks. If you're not comfortable with that, it's a little bit different. It's probably a little more less risk, for some people's portfolios. People that don't want the volatility to have to deal with that, having to think about that. So I'll throw up these slides. But the three big deals themes that Brookfield is looking at is decarbonization, deglobalization, and digitalization. So it's back to that. The tech stack, as we've talked about, the tech stack requires a lot of energy. Deglobalization, which we started talking about in solving Europe's energy crisis, and we talked about it with Macron's concern about our IRA legislation. Deindustrialization, deglobalization, same thing. It's all nearshoring. It's all these, facilities and manufacturing, semiconductor plants, and all these things that are coming to the United States. So all the reasons we've discussed in our last 4 videos. In fact, I mean, we just keep evolving this, and this, watching this movie, we've got sequels going here, Michael. But anyway, let me just screen share some of these. So this is from Brookfield, BIP. And basically they're saying that, inflation, so with their organic growth, even, exceeding expectations, inflation is a factor for them. And their long-term outlook is that macro trends support elevated levels of inflation. We've talked about this before, where I said, decarbonization is going to cost money. We're spending more to decarbonize because we're having to pay the cost of the externalities that we have created over time. It's a cost, and it's inflationary. All these EVs, all these charging stations, wind blades, all those critical minerals that we've talked about. We saw what happened to has been happening to commodity prices. All those minerals that go into these everything that we want now, it's new, it's additive, it's increasing mining. That's inflationary, right? And then the other thing that, one of their sort of interesting, this is just Brookfield's strategy, a way to package up what they do, and it's building new platforms. Now, I think it's a cool idea, and I kind of haven't dug into it, but I thought it was smart. So now this is BEP. This is the Brookfield Renewables stock. And this is their outlook on US power generation, which I find instructive. This is back to the decarbonization issue. So they're projecting US electricity consumption in 2018 were like 4,000 terawatts. And they expect an 80% increase at 2050 in the high case. That's, guns a-blazing. And it's kind of fairly evenly distributed amongst the segments. Commercial, it's a tad bit higher. And this is, again, with those trends of increased electrification that BP expects, and which ultimately drives down some oil and gas, depending on what you're using on your grid. Grids is a whole nother topic, and I've started talking about that again in my Texas $1 Million Mile article, but I'm not going to go there now. But now an 80% increase in like 25 years. I don't know, it seems like a lot, but so now this is this is just kind of a visual on how deglobalization looks within. This is from BIP, Brookfield Infrastructure Partners Fund. And so how you can play in that with them is LNG export facilities, they have stakes in that. Supply chains, this is Australian ports, stakes in that too. Semiconductors, they have stakes in that. So the interesting thing about a Brookfield infrastructure type fund or stock is that you can have diversification in some of these growth areas, and again, it's near shoring. The semiconductor, we passed legislation specifically for all that manufacturing to do with supply chains, which the pandemic revealed. So you see, this is a way to play some of those trends I've been talking about before. Remember, I was saying supply chains is, something. As a matter of fact, I think engine number one just came up with a new supply chain oriented ETF. I just saw it today and I'm like, yep, there you go. Okay. So hats off. So, and then the other thing, digitalization, the tech stack. So according to BIP data, world's fastest growing commodity, 1 trillion expected over the next 5 years to upgrade infrastructure globally. Nice picture here over the peaks here. God, that's high. So, again, with the tech stock, that really, it's going to require energy, but they're investing in that. And I've done a little work on that as well in the past. And this is, again, just something about their strategy long-term is building platforms. They're trying to figure out, how do we integrate? This is like an Irish wind business. They acquired it, they, upgraded it, built this platform, sold it, and then, sold to strategic buyer, generating 15% return over an 8-year hold. So just kind of taking their slices and recycling these investments out, so that's kind of one interesting idea with infrastructure. Now, this is looking at some of the performance issues, because people may look at, if they go to your website and they look at BIP, they're going to be like, oh God, this looks, there's a red warning here, red label. But I'm showing you a snapshot here. And this is for example. So this is 1 year, and across 1 year, BIP down 15%. The renewables portion of Brookfield down 20%. iClean up almost 12%. S&P down 8%. Okay, and then PAX DX, this is a stock I've had for a long time. It's a sustainable infrastructure fund. They were only down 6%. They have less volatility, which is, I find, kind of interesting. AY is a Spanish based infrastructure fund, but they're global, and I hold them as well. But so in 1 year, you see, negative 15%, negative 20% on Brookfield. And then what I'm going to show you next is, and this is year to date. So now up, what is that? 9%, S&P 9%. The renewables not up as much. What is it? 5%. iClean not up much. PAX DX up 5%. So what's happened even this year is, with interest rates where they are, investors are rethinking, where they're putting their money. A lot obviously is going to fixed income, safer returns, better returns than, before. But infrastructure, again, sort of mimics some of that type of investment, which has been out because it's been an equity world for a long time, right? And then the other one I'm going to show you, again, performance here is 1 month. Even in the last month, you just have all this volatility. So now BIP in a month, less than down 1%. S&P up 3.5%. iClean down 6%. PAX DX is 1%. Interesting that fund has not lost as much when others lose. It's got less volatility to it. It's a mutual fund. So that's kind of an interesting dynamic I noticed. So I'm trying to see if there's anything else to do with this. No. I think that was the last slide, and we'll stop sharing. Okay. So, yeah.
So is that going to be the story for them 20? I mean, that's a lot of information for me. But it seems like infrastructure investment could be the theme, a key theme at least for 2023.
Well, I think it's something to look at. Like I said, it's an alternative way to play the energy transition that maybe you might feel safer about, as opposed to, oil and gas stocks, which have more volatility. If you're closer to retirement, and you're not comfortable with stocks that drop 5%, every time something happens, every time there's something geopolitical, every time they're volatile, let's face it. But for me, I'm going longer term. I'm looking out further with oil and gas stocks, so I tend to just know to ride that out. I don't get bothered about volatility. It's going to happen. Some people will. And so I think, but I put infrastructure funds in my portfolio to temper volatility, because there's a lot of academic work about returns. And there's always that saying, you can't beat the market. Well, it's pretty much true. And they've shown that, it's you're actually going to do better with something that's kind of steadily plodding along, than something that does this and has to constantly make up time, investment time. And if you don't have that time in your portfolio, then you want to do it differently. And we know interest rates are going to be at a certain level, right? And they're not going to go down anytime soon, for sure. And so the infrastructure funds again, having a bond like attributes, and then being largely indexed to inflation, so that's just another way to play stocks. But I think there's a big rethink on how to invest. I mean, I think and British Petroleum, BP, even in updating their outlooks, it's good that they did that. Now they had to do a sharper reversal than some of the other, like the US majors, who have been rewarded. US majors, CVX, ExxonMobil, Pioneer, they've all been rewarded for going slower. The European majors, not so much. They got hit because of what happened in Europe. And when everyone realized, this energy transition isn't going like we thought it was going to go, and so they've had to course correct. I mean, you cannot have your peers totally outperforming you, and you're going, oh, Jesus, I better say something different, but it's good. I mean, but they still have their ambition. They still have their outlook about it. That's not changed, but they're just going to go about it a little bit differently, given the context, given the changes, given the Russia-Ukraine war. Like we've said, it really changed the energy outlook. It changed it from, decarbonization focus and all that entailed, with demand destruction and all that, to energy security, affordability, kind of like, oh, okay, we've got to come down to reality now with what we have. Because also with the energy transition, as we know, inherent in these ambitions are increased mineral use, increased resources. It's going to cost a lot to modify the grid, the EV push, a lot of it based on subsidies. Do we want another entitlement program? we can't afford it in the United States. We've got Medicare and Medicaid. We can barely afford that, and Social Security. You think we can afford a green entitlement? And that entitlement's going to people that make more money. So, you do the math on that, and that's why I've said I'm very careful about business models driven by subsidies. Fine, if you're going to do some innovation, get the subsidies, get some government help, some PPP action, public-private partnership to advance innovation in what you're doing, but don't rely on it long term, because the market has to support that. The market has to believe in your outlook. So.
Great. I think we've covered a lot. We covered the macro stuff from the Davos Fed, the oil and gas, what the companies are thinking about, infrastructure. Is there anything we may have missed?
Yeah, we did cover a lot. I mean, we discussed Texas. I mean, one thing too, back to Texas is, it's kind of a unique situation, but it's also, if you look at the growth here and then the soft landing prospects, we're kind of a best case scenario, right, of what could happen. And if we miss the best case, well, then we have to rethink some things, but it's a big rethink on everything, right? And I think that's what makes it kind of exciting, because you just have to consider new things, new ideas, really. And this dislocation we're seeing, with the energy transition, with interest rates rising, with this dislocation, creates opportunities, right? All the M&A that's happening in oil and gas. So there's just kind of this great reshuffling. And then, as investors, we're just trying to figure out how to stick the landing, right. And, so a little bit of investment gymnastics, but
it's going to be tricky, right?
Yeah, it's a tricky time, but yeah, that's why I was sort of like, I think the infrastructure aspect kind of helps soften some of that oil and gas, discussion we've been having in terms of investing. So.
And I think with infrastructure, like you said, it's if you've got a long-term time horizon, it could be a very it might be slow and steady, but it could be a very, very, I guess, profitable, very lucrative kind of way to look at investing.
Yeah, well, because also the dividend yields on those stocks is 4 or 5%. Sometimes it can be higher. So it's right in there with treasuries, long-term treasuries and stuff. So for less risk, right? These funds are very aged and stable, so to speak. Most of them tend to be that way. It's just it's just different perspective. So
for sure. Well, anyway, I think it's another great conversation with you again on where things are going, and the long-term horizon is very interesting. I mean, I think if people had that long-term horizon, it could be something worth their time and energy to review and investigate.
Well, and I even think even for the next, 1 year, 2 years, 3 years, 5 years, I think we have some secular trends that are real, that they have nailed, digitalization, tech stack, decarbonization, and deglobalization. Those are all, but they're all inflationary, and they all, so that's a factor. So that's what makes it all, fairly attractive. And, pick your funds, do your due diligence,
right.
on that. So I will stop recording.
All right. Well, anyway,